Hi everyone, this is Rohit Srivastav and I welcome you to Algos R Us. Today we are going to be learning a little more advanced model than we have covered so far. This is a model that uses three moving averages and the commodity channel index to generate buy and sell signals. I like to call this the Alligator model, but this is not to be confused with the Alligator indicator which is available widely. And this model of mine was just inspired by that, and that's why I like to call it Alligator. So let's quickly begin. I am not going to be coding the formula. If you want, you can also copy paste the formula from what is given below the video on the website. But what I am going to do is run you through the formula that I've already written. So basically we are defining three arrays out here: largest, medium and smallest. For the largest, we are going to be having the maximum number of periods, which is at 100. For medium, we are having a 25 periods, and the smallest is a 7 period. They basically, I've done this because I would like to be able to optimize them if I wanted, and that is why they have been defined as arrays. Then further on, another array has been defined. This is more for the purpose of explanation. So orange is basically EMA, which is the exponential moving average of close, 100 period, which is the largest. So 100 is the value that is coded into largest. Similarly, blue is a faster moving average, which is the DEMA on close and medium, which is 25 period. And then the white is the fastest that is a DEMA, which is a triple exponential moving average, and the smallest period of 7. The reason I've coded, I've given the arrays these names is because these are the color of the lines that are going to be plotted, as can be seen through these plot codes. The lines that I've used I've changed the style to thick because there are going to be a lot of lines on this chart in addition to the candlesticks, so it might be a little confusing, and some lines would not be visible. So that's why I made them thick lines. So basically, let's go to buy and sell and see how to generate this the trades. Now, basically, buy happens when the white, which is the smallest the smallest period and the fastest moving average, is greater than blue, and in turn, blue is greater than the slowest and the longest period average, which is orange, and finally, the commodity channel index of 25 period is greater than 80. See, basically, commodity channel index is another indicator that shows buy, overbought and oversold positions. So we are going to basically be using that to identify whether the market is trending, and then enter into the trades. And the position is exited, or rather closed, when the white crosses the orange from above. Similarly, short is the opposite of what we had entered for the buy, when white is less than blue and blue is less than orange, and CCI 25 is less than minus 80. CCI has got basically both positive and negative codes, so that's why we've coded it as minus 80. And cover is equal to cross of orange from below by white. Then we've got the XREM to remove the additional buy and sell indicators that would come. These ensure that we are just going to have one buy followed by a sell and a short followed by a cover, and not multiple shorts being entered. These are our apply stops of 1% maximum loss and a trailing stop loss of 2.5%. What I wanted to also note down out here is that suppose you want to note down a comment against near a formula, and you don't want AmiBroker to recognize it or as a formula, or so that there are no errors. What you basically do is type / type whatever you want to. This is a trailing stop loss. So this would be in green color, and AmiBroker is going to recognize this as a comment and not as a code, and not going to look to execute it. Then we've got our shape longs that are done. Over here we'll have to code another shape short also, because unlike our previous indicators where a buy was same as cover and a sell was same as short, over here buy and short is going to happen differently. So not every cover is going to be a buy and not every short is going to be a sell. So there might be some of the cases where if there is a huge price movement that this happens, but in most cases is going to be unlikely. So that's why we plot them accordingly using the same logic as earlier, and then we just copy paste the price formula out here, right? Let's just apply this indicator and see how this looks, right? Let's close the earlier price and let's just quickly plot the commodity channel index also for a period of 25. All right. Let's just find a decent beginning of a buy or sell. Right. Let's take it from here. So here we can see that the fastest moving period, that is white, went over the slowest, which is orange, and that triggered a cover signal. But this did not, as I had said, this did not trigger a buy. For buy, we are waiting for the right conditions. One is that the blue should be over orange and white should be above blue. So this is where the condition comes true. But there is another condition, that is a commodity channel index should be greater than 80, which is not the case because it is only 34.92. So let's see. None of them, it does not get, all the conditions do not get fulfilled in any of these candles until this one. This is where white is above blue and blue is above orange and the CCI is over 80. Now this is where the long signal is sent and the long position is entered, and this is quite a long trend and it goes on for quite a few days actually until here. Now see, white basically cut the orange from above, and this is where a sell signal is sent, closing our long position, and there's no short executed because again we're waiting for the medium line, which is blue, to come down, and this is where it happens. And even our CCI is below -80, so that's why a short position is entered. Over here it closes. This was a loss making trade, but our formula is being properly fulfilled out here. So let's quickly go back to the formula and run a back test of it on Nifty just to see how it would have performed. Tools backtest. So back testing on Nifty, same settings as earlier, 15-minute interval, a brokerage of 0.035%, account margin of 100, so no leverage. And let's click on report. That's pretty decent performance, an annual return of 28.41. We had a total 632 trades generated, of which 30% were winners, so that's a low winning percentage, but which is likely the case with most trend following models. We had a very high average profit of 2.5% for winners. For losers, we had 70% losers, but the average loss on them was only 70 bips. The max drawdown 23.505, a little on the higher side, but that's all right. Let's move on to the charts. A fairly reasonable chart. The maximum drawdowns happened towards the end of 2012 and 13, and recently we've had a drawdown of a little in excess of 15%. This is our monthly returns. So we've had 1 year where it was loss making, and in 2015 so far it has given us a return of 14%, not including the results of November and December, for which the data is not there in the AMI broker at the moment. So it's definitely outperformed the Nifty in 2015 so far, because Nifty is given a negative return. Let's just see how it would have performed on the Nifty. Again, a decent performance. 16% is the CAGR that we have. 584 total trades executed. 33% winners out here, and a max drawdown of 12%. The chart is fairly linear, and even in this, our drawdowns are towards the mid of 2012 and early 2013, but in none of the years do we experience losses. So let's just explore another thing, which is a Monte Carlo simulation. We'll do it on Bank Nifty. See, what is first? Let me explain what Monte Carlo is. There are a lot of trading models which can be made by seeing the past performance, but to really understand if the model is robust or not, Monte Carlo simulation is used. What Monte Carlo simulation basically does is that it randomly changes the trades. So for example, these are the trades that are occurring. So the logic basically is that our model would have executed these positions irrespective of when they would have occurred. So what Monte Carlo does is it changes when these trades have occurred. So it will just randomly shift it up and down to understand how the drawdowns would have been affected, or even the CAGR, how it would have been affected. So the number of iterations that can be run on this can be changed from settings, Monte Carlo, number of runs, so that's 10,000. You cannot have more than 10,000 runs in from this settings tab. But if you want to run more than that, you can enter a formula into the AFL for running more iterations. And let's just back test it. Let's click on Monte Carlo. So there's a little less than 1% chance that rather a little more than 1% chance that our annual return will be totally our equity would be totally wiped out. And at 50%, we are going to be having a CAGR of 27.57, close to what our model was giving, and a maximum drawdown of 32.31. Now this is something that should be noticed. At the moment, what a drawdown is actually there is somewhere around the 25% mark, and we could be expecting at 50% at 32.31%. So even at 52%, at 50% level, we could be expecting a probability of 30% drawdown is very much there in this model. How I usually like to handle Monte Carlos on the first glance is that while backtesting a model, I should be comfortable with the returns that are there at 10 percentile, and I should be comfortable or open to the drawdown of the worst case scenario at 90 percentile. So if I was comfortable with 15.64% CAGR and a drawdown of 62% CAGR, 62%, then I would trade this model. Let's just see, these are basically percentiles. From here we'll have a better understanding. These are the graphical representations of the various analysis that was done. So at 90%, yeah, it's approximately 62% that is there at 90%. So and at 50%, yeah, approximately 30, yeah. So what usually the drawdown that I take as system failure, that I look at it, that I'll keep trading the model until that happens, is at somewhere around 65% level. So over here for this model, this would be around 40%, that I would keep trading the model until I had a drawdown of 40%. Let's just have a quick look at the Monte Carlo for the Nifty. So Nifty, oh I'm sorry, I'm doing it on Bank Nifty only. I'm going to click on backtest, report, and Monte Carlo. So it's a shade better for Nifty, but again I should be okay, comfortable with a return of only 9% for a drawdown of 28%. So this is, as such, on the face of it doesn't look to be that great a model, but imagine a scenario where you could trade. So for example, on I like the low drawdowns that is there on Nifty of almost 12.06%, but I like the higher returns that are being offered by Bank Nifty, but I'm not too fond of the drawdown that is being offered. I mean, that is on the cards. So what would happen if I were to, let's say, trade equally on both of them? I mean, how would the model look? What kind of returns that would be given? So you can do that by, first let me just show you a couple of steps. So we go into, you select the symbols that you're going to be doing this test on. So I'm going to be doing it on Bank Nifty. So go to symbols, favorites, add selected symbol, then go to Nifty, that's the other one that I'm going to be doing, and symbol, favorites, add selected symbol. So both of these symbols have been added to favorite. You should be able to see it when you click on this define filter. Favorites, yeah, Bank Nifty and Nifty have been defined. Now how do I trade on both of them? If you simply click backtest on this filter, the results that you get, annual return of 30%, drawdown of 15.5. This is actually not really right. This is not right, because what this is doing is it is trading in whichever of them, whenever so we are investing 100% capital first in Bank Nifty, then when the exit happens, it's going to track both of these systems, both of these indexes, and wherever you get a chance to enter, it's going to put in 100% of the capital. Now that is not what we want. What we basically want is that it should keep equal capital in both of them. So for example, you have 10 lakh rupees, it should invest 5 lakh should be for Nifty and 5 lakh should be for Bank Nifty. Now this can be done with a very simple formula, which is set position size this is 50. This is a percent of equity. So 50, we don't need to write percent because that would be there in the method, percent of equity, and we get it down here, just there. Now we can backtest it out here, so let's do that. And let's do that. Click on backtest. We have taken apply to filter, and there we have it. Let's have a look at the equity chart now. And there you go. You have a CAGR of 22.54, which is higher than what we would have had in Nifty but lower than Bank Nifty. And look at the drawdown now. It's 16.7, and it's so much better than the 23% that was there of Bank Nifty. The chart much better. We're still having the drawdowns, maximum drawdowns that are there in 2012 and 13, because that was true both for Bank Nifty and Nifty. You can check on symbols. You've got Bank Nifty and Nifty both being traded. And now let's see the Monte Carlo. Look at that. So there's no percent. Look at this curve out here. So your equity, even in the worst case scenario, doesn't reach zero, right? The red one is the worst case scenario, and now at 16%, which is 10%, 16%, and 25%. Yeah, I mean, this is something that I would be fine with. And that's the beauty of it. You can basically take a model which is not that great, but by diversifying it and trading it on two indexes, you can actually have a much more better model. I hope you understood what I was trying to get across with the Monte Carlo analysis. So just in short, let me just go over what we what we've covered so far. we basically created a model which was the alligator model for 3 moving averages along with the commodity channel index, and we learned the formula of set position size and also how to make comments or leave comments in the formula by entering slash double slash and then typing whatever we want. Just ensure that it stays in the same line, because if it goes into the next, it is taken as a formula, right? I hope whatever I've explained out here made sense to you, and you're going to use it sometime in developing your own model. I hope to see you next time soon. Take care. Goodbye.